There are all sorts of different types of trusts. For example, a will is a type of trust, as is a self-managed superannuation fund. Both of these trusts involve assets being held by trustees in trust for beneficiaries. The precise wording of the trust documents may be different. For example, a trustee may be known as an executor in the case of a will, and the beneficiaries are known as members in self-managed super funds, but they work under many of the same principles as a classic trust. In this DVD, we will look at the following types of trusts. In the first group, we have the fixed and unit trust variety. In the second group, we have the discretionary, or sometimes known as the family trust variety. And the third group. In this group, we have a combination of both fixed and discretionary elements, and they're generally known as the hybrid trust variety. Fixed trusts. This is the most traditional form of trust, and each beneficiary has a fixed or predetermined share of either the income or capital of the trust. The fixed entitlement is often represented by a fraction or percentage and is set out in the trustee document. A unit trust is a type of fixed trust where each beneficiary owns a specific number of units. Each unit holder is entitled to a proportion of the income and capital distributions of the trust. Many publicly listed enterprises adopt this type of trust, such as the managed investment funds, for example. Fixed and unit trusts are generally used when parties are going into business or getting into an investment who are not related to each other. An example of this are when two investors intend to purchase a property and want a fixed financial return based on their investment. From an asset protection point of view, these types of trusts are not as good as discretionary trusts because a creditor, a person who you owe money to, is able to trace ownership of the beneficiary's direct interest in the trust deed and the trust fund, and this interest in the trust fund's assets will form part of the beneficiary's personal assets and may come within reach of a successful creditor against the particular beneficiary. Discretionary trusts. A discretionary trust is not fixed and is classified as a non-fixed trust. The distributions are determined by the trustees. This type of trust offers the greatest flexibility and is the most common form of trust in a family situation. There is considerable flexibility from a tax planning point of view, enabling income to be split between beneficiaries in the most tax-effective manner. 1 year the trustee may distribute all entitlements to one beneficiary, and the next year the trustee may exclude distributions to that beneficiary and distribute to all other beneficiaries of the trust. As it's a discretionary trust, the distributions are at the discretion of the trustee.